Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topic subjects, looking for investment opportunities and sharing them with everyone in the community. We do have special as a coupon code that can provide savings for both the monthly and yearly memberships. Starting with top-down charts, emerging markets are emerging. Thoughts and next steps and catalysts. So here's emerging markets versus developed markets. You know what a good time would be to buy commodities? Here, 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 and here. Emerging markets, weaker dollar, and lowering, well, in this particular case, if they do lower interest rates, I do think we're going to get a weaker dollar, which will push emerging markets up against developed markets, in my opinion. And that's what we'll be looking for. Commodities generally do well when emerging markets outperforms developed markets. And I think it deals with dollar fluctuations, the value of DXY, and the dollar's value against whatever other currency you're measuring it against. As currencies, emerging market currencies, outperform the United States dollar, you start to see money flows into those emerging market currencies. So it's coming. It is an indication of a commodity bull market that is coming, and an emerging markets bull market. Warren Buffett: dream big and be prepared mentally and financially to act fast when opportunities present themselves. Every decade or so, dark clouds will fill the economic skies, and they will briefly rain gold. What does that mean? What it means is you need to get your super high intensity training, your SHIT, together. Get it together and learn these cycles. I benefited from understanding the real estate cycle and buying a house earlier than what I would have normally purchased it. I refinanced at a certain spot when interest rates were low, and it really set my life up differently than if I had not known that cycle. And if I had known the cycle even earlier, I could have bought even earlier and had even a better entry point into the housing market. So I did the savings part all right. That's where I saved a bunch of money. I was unaware of the real estate cycle, and I was unaware of how these cycles impact financial markets. And that's where all of the special sauce is. It's understanding the longer cycles, waiting for a great entry point, and then getting in. But entry points don't come every year. If you understand the cycles, they come like once every 9, 10, 11, 15 years, depending on what you're looking at. You might have a more frequent purchase rhythm than that, because you can also go into other asset classes that are down. So commodities are generally down when financial assets are way up, and then they switch over time. Not knowing that puts you at a grave disadvantage, because I am playing this cycle to the max. I am leveraging what I know about the markets as much as I possibly can. I leverage the technical analysis that I know, and then also the ratios that gives you a good some good data to determine where you're at in the cycle. So, but Warren's right here. If you prepare mentally and financially, and if you get a really good opportunity, that's when you snatch it, guys. That is when you make tons and tons of returns, and they don't happen often. I would say the last very large opportunity, gold in 2022 was a big opportunity, and silver and platinum. And then other ones, the bottom of 2020 was a huge opportunity to buy in oil. Energy service companies were really low, and they're pretty low right now, still at a really good opportunity. And understanding when those opportunities exist is everything. If you have no idea how to identify an opportunity, then you're no better than looking at nothing. But if you know when a good opportunity exists and you can pounce on it, that's everything. That's what being an investor is. It's understanding what you're looking at and then making a decision on what to do, irrespective of other people, irrespective of emotions and feelings. And more than likely, you're getting the deal and you're taking advantage of others, so to speak, and their fear. That's how you're doing it. You're buying when they're selling. Gurian Rosenzweig, shale growth is slowing, inflation risks are rising, commodities are entering a new cycle. There's that cycle talk. Our quarter two 2025 commentary breaks down where capital would flow next, from oil's repricing to uranium's bull market. Yeah, I think all of commodities are going to go up for the most part. I'm not as big in the soft commodities because their cycles are they can be influenced with supply coming on very quickly. Copper and some of these large mines, uranium mines, it takes many years to bring these on. So when we squeeze, it will squeeze for a while. There's nothing that's really going to dampen it in the very short term from a mining perspective. The NASDAQ 100 of emerging markets is resolving a massive bearish to bullish reversal pattern, printing fresh multi-year highs. So there's that big kind of roundish bottom. It gives the perception of a cup and handle, but it's not. Cup and handles are continuation patterns. You would start it from over here and go all the way up. But yeah, it does look bullish. We are breaking out of some resistance through here and working our way on up. And that's emerging markets. Emerging markets look pretty good. Eric Nuttall, oil inventories in visible areas like the US remain at multi-year lows, while total global oil inventories have climbed this year meaningfully, more than average. The OPEC exports set to increase, and Guyana, Brazil ramp. We think OECD inventories will soon begin to loosen. Now, let's see if that happens. I'll remain open to see what happens here in 2025. Either way, I think 2025 will be the bottom. Probably quarter four 2025 will be the bottom of all these, additions and projects. Shale will probably peak out or something like that. We don't know if OPEC is really going to increase production, aka exports. That's really what matters. But we'll watch it. They can increase their what do they call it? Their limits, their quotas. It doesn't mean that they will actually produce more and export more, and that's what we'll watch and see. Coming down, we got Tavi. Normally, when metals perform well for a few years, producers ramp up output to capitalize on the favorable environment. Not this time. Decades of underinvestment in the mining industry have been so severe that there are virtually no significant new mines coming online to meaningfully change the supply curve. Some think this problem is unique to silver. It's not. While the imbalance is more acute there, other metals face the same challenge, a shortage of new supply on the horizon. This is one of the main reasons I believe this metals and mining cycle is likely to last much longer than prior ones. Lastly, in case you were wondering, when it comes to silver, Mexico is essentially the Saudi Arabia of the market. It accounts for about 25% of global supply, an even larger share than Saudi Arabia holds in oil. The fact that Mexican output has been in multi-year decline poses a profound challenge for the silver market. So here's silver prices heading higher here ever since, say, 2016. And on the bottom here, this is Mexico silver production. It's in decline, making lower highs and lower lows. What's going to incentivize Mexico to increase production? There is an answer that says nothing will. At some point, whatever that thing is, it could be silver, it could be copper, it could be oil, natural gas, coal. There's a point in this world that we will never be able to produce more than a certain point. That's what peak oil would represent, or peak silver, or peak copper, or whatever it is. It's where ore grades decline to certain levels, and you just can't flow the material as fast as you used to, and that would peak supply. Is silver at peak supply here in 2016? I don't know. It could be. What would that mean? What that means is that if prices go up of silver, that the response in supply would not go up. No matter what they do, no matter how much money they spend, the supply would continue to go down, irrespective of price. Now, I don't know if the world's at that point yet. We'll have to wait and see. And if it is, things will get really interesting. It will get interesting because the value of stocks, I should say, the value of companies that convert commodities to usable products are going to fight over their inputs. Prices will go up. Companies will fight over those inputs. It'll be, at first, prices will fight. And then if prices keep going up and the commodities start to get really scarce, I think companies will just start to buy mines out. I'm not sure if we're there yet, but it could be out in the future. Maybe it's a few years or 5 years or 10 years. I don't know. Jesse Day on today's commodity culture. Gary Savage is extremely bullish on precious metals, and he believes we're in the early stages of a cycle that will easily take gold to $10,000 an ounce and silver well into the triple digits. Does that agree with what I think? Yeah, I would agree with that. I got no problems with that. 65% of employees reported feeling stuck in their current positions per Glassdoor. Yeah, I wouldn't say I was stuck, but um, I didn't want to move in my position when I was working. I just stayed where I was. It was easy. I knew the drill, so to speak. I didn't want to go anywhere else and have to learn all their systems, get like 5,000 new passwords, talk to a whole bunch of people I don't know. As you get into these companies, you need to know like the support group of the company. And it's tough to learn that really quickly. But you need to know, if you have an IT problem, who do you call? And most of these companies, it's like 8 billion people that you call. They have like 8 billion different things. There's like 5 people in HR, one for hiring, one for discipline, one for like promotions and stuff. There's all these different things that you have to go through. And then if you have to get a promotion for somebody, you might not be able to go to the direct one. You may have to go to their boss and get signatures and get their boss's boss. It's a total, pain in the butt. So I could see how 65% of employees report feeling stuck. That makes sense. And I bet you a lot of them don't even want to move up. At least that was me. Fortune has said that there is noticeable drops in traffic at restaurants, shops, and malls, fewer people traveling or eating out, increased coupon clipping, and price sensitivity. Well, I mean, I don't really eat out anymore, but I don't go to work. I don't go to a 9 to 5. I stay at home and do other things. So I basically cook at home. I did go out not too long, a couple of weeks ago, maybe, or maybe it was like a month ago. I don't remember. I went out and I ate. I think it was Chipotle or whatever it was. And I was like, man, this doesn't taste that good. Like it just doesn't after you cook stuff at home and eat stuff at home where you're eating, top of the line. I wouldn't say top of the line, but you're eating like good food and good ingredients. I mean, the difference between some of these ingredients out there, they probably stored in bags and then heated up versus like eating it fresh. It's a big deal, like old celery versus fresh cut celery, just cut and put into something. It's way better. Energy markets, both oil and natural gas, are deeply out of favor. Investor sentiment towards the energy sector is negative. Be greedy when others are fearful. Skate to where the puck is going. Valuations in the energy sector are among the cheapest in the market. Balance sheets of companies in the sector are very healthy. Many pay very attractive and sustainable dividends while also buying back shares in the open market. Consensus is that quarter four 25, quarter one 26 oil supply glut is coming. This narrative is currently being used to justify avoiding the sector. Beware widely held and well understood narratives. See Bob Farrell rule number 9. I feel the far greater risk in the market is a supply shock, actual production not meeting forecast, rather than a supply glut. Demand is steady and rising. Global addiction to oil and gas will not peak for many, many years. See India as the next major economy to move up the S curve. Buy low, they say. Always hard to do because low prices require bad news. Sell high, they say. Always hard to do because high prices exist amidst a flurry of good news and ever improving fundamentals. Just a few things to think about. Well, here's my opinion. I think the energy market's already bottomed. The companies, the equities. The equities have bottoming patterns that occurred months ago. So we're actually already bottomed and working higher in a lot of the companies that I follow. There are a few that are still low, that are breaking out of bottoming patterns as we speak. And those are ones that I share every week with everyone on the website. But a lot of them, and the majority of the stronger companies, they've already bottomed. They are heading higher. And there's a whole bunch of companies doing share buybacks that are forcing their stock higher. A lot of them are breaking out against oil itself. So that ratio of the equity divided by oil or the equity divided by natural gas, they are outperforming the commodity itself. That occurs in bull markets. It doesn't occur in bear markets. Bear markets, you'll see the equities dropping like a rock in relationship to the commodity. So we're in a bull market. I'm not just fairly confident, I'm very confident that we're in a bull market, which is a very long, drawn out bull market. I think we went through wave 2 in Elliott wave. So wave 2 is the pullback, and I think we are entering wave 3. And I think we're going to see a big move across the commodity space, not just energy. Now, energy is lagging behind some other sectors. It's definitely lagging behind the mining sector, which is killing it. And it could lag behind for another quarter or two. It's completely possible. But when it does heat up, I think we're going to see a launch. And we're going to see a launch across everything, I think, in commodities related stuff. A lot of stuff looks really, really good. Of course, I hit the wrong button there. Sorry, guys. Coming down, people don't even see it. We're already in recession. 2021 was child's play compared to what's coming. Countries are spending like lunatics, debt exploding, deficits everywhere. Own gold, own silver, and if you want dreams, own juniors. This is the leading economic index divided by the coincident economic index. So these are bottoms here, and you can see we're really low. I view this different than everyone else. So this guy, he's worried, whoever he is. He's worried, oh, we've already been in a recession. Guys, this is a bottom here. We're coming out of recession. Go look at the charts. Not this, but go look at how the positioning is in the market for energy and for copper and for silver and steel, iron ore, those are bottoming and turning higher. So the leading economic index divided by this, that already occurred. That's looking backwards. We want to look what's forward. And the market is forward looking. So we want to see how people are positioning in the market to take advantage of people that do this. This is wrong. You want to look to see how people are positioning. You want to see bottoms, and then you aggregate your charts up, the hundreds of charts that you look at in all these different sectors. You aggregate it up into an opinion. This here, I think, is more lazy, or they don't know necessarily what to do next. The charts will tell you across, if you look across a whole bunch, which are all bottoming, that more than likely the recession is behind us, and that we're bottoming and people are taking position. And that's really what matters, right? You want to be accumulating when the smart money's accumulating at bottoms. Opportunity doesn't come often, so seize it when it comes, says Charlie Munger. There's a whole bunch of opportunities that are occurring right now. Right now. U.S. Department of Energy stocks for week ending that for the EIA. Crude's down 2.4 million barrels. Gasoline is down 1.2. Distillate is down 1.8. And Cushing is down 1.8. Crude X SPR minus 1.6, SPR 0.8 build. You can see how low we are. Crude oil stocks, this is declining. Gasoline. Distillate is still really low. Cushing stocks are on the low end. And then U.S. refinery runs, they're running them as fast as they can to try to catch this back up, and they can't catch back up. U.S. crude oil production looking a little, we had a little bit of an uptick there right at the end there. EIA inventory moves, it's the same as the one up here. So minus 2.4, minus 1.2, and minus 1.8. I've made a lot of money betting against Goldman Sachs, buying oil stocks this morning. Flashback to 2015, Goldman Sachs was bearish on gold. Yeah. Guys, you don't need to use Goldman Sachs. You don't need to know any of that crap. Watch the charts, look at the ratios. When things get cheap and they get squeezed up, that's when you go. Sentiment towards the energy sector remains miserable, while valuations relative to other sub-indices are extremely compelling. The only upside from this, Canadian energy companies year to date have been able to buy back 4.8 billion of stock at attractive prices. I like it. This is energy at $70, energy at $60. So this is 2025 consensus free cash flow yield, which is higher than all the other sectors. And the consensus enterprise value divided by EBITDA, this is a function of value. It's super cheap. This is the best sector to look at in all of the market right now. You pay the least and get the most yield or return. God, I love energy. Money managers have never been this bearish on crude oil, and we're right up against support, bouncing positive, hitting it and bouncing. And we'll see if we can break out or if we're going to head lower. This is the largest net short position ever. I like it. Soon governments will have to choose AI boom or cheap electricity for consumers. You can't have both. Well, you know what I see? I see a big move up for U.S. cities' average electricity price. And in the back of my head, it screams coal. Maybe coal can benefit from this. Maybe natural gas can benefit from this. And I just look for investment opportunities. So when I see electricity prices going up, I think, hey, maybe we're going to reopen some coal plants, get some more coal demand going to try to alleviate some of this power demand with a little bit more supply. I don't know. We'll see. The yield curve steepening equals a commodities surge. Every major steepening of the yield curve has aligned with a melt-up in the prices of commodities. The pattern is clear in the Reuters Jefferies CRB index. So here we are going higher, and then we are moving up in the steepening of the yield curve. So steepening, move up. Steepening, moved up. Steepening, moved up, and steepening is moving up. Love it. Weaker dollar, higher prices. It's worth reminding ourselves from time to time that gyrations in a stock price may tell us absolutely nothing about the prospects of the company involved. Mr. Market is there to take advantage of, not for his advice. Almost everyone gets worried when prices go down. When prices go down, it means absolutely nothing about the prospects of the company involved for the most part. Most of those price movements mean nothing. Brent Futures AM update. We've got dry bulk, Capesize down 3%, Panamax down 2%, and tankers, VLCC down 1%, and Suezmax down 2%. These are all these big picture precious metals ratio charts below have now broken out. The global capital rotation into precious metals started when these ratios charts below turned, which I posted in real time back on for each chart. So these are the charts, GDX versus NDX. This was the bottom in 2024, and we've broken out of the falling wedge to the upside. This is what precedes price movements a lot of the time. You'll see bottoms in a falling wedge, and you just have to kind of get in at these corners. Same here, another falling wedge where it's the gold miners versus semiconductors that have broken out of the falling wedge. Now you just let it run. We're in a bull market. We are in a bull market. Here's another one, silver versus US stock index Dow Jones. Falling wedge, breakout. Here we are moving higher. And this is gold versus the SPX. That's broken out, and we are working our way higher. You just let it go. We're going to be in a bull market for years, guys. Years. Last big bull market was back here. You can see the big bull market. It started in 2000. 2000 to 2011, and now we're starting down here, 2022, 2024, somewhere in there is where we're going to start the big bull. And that's all I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website, special with coupon code. We do have a Q&A session coming up this weekend, Saturday at 7 a.m. Mountain Time. All right, guys, that's all I've got for today. So we'll catch you later. See ya.